This is the Asia Trade. I'm Haidi Stroud-Watts in Sydney, where the market has just opened. The top stories this hour.
The tariffs are going forward on time, on schedule.
The loonie and peso slide after President Trump says tariffs against Canada and Mexico will go into effect next month. Alibaba's US shares also tumbling on fears of deepening trade tensions between the US and China. The Trump administration breaks with allies over the war in Ukraine, withdrawing US condemnation of Russia's invasion at the UN. And the Bank of Korea is expected to cut its benchmark rate by a 1/4 percentage point as it looks to shore up its economy against Trump's tariff war. Well, Asian stocks are set for losses as we get that continuation of the tariff threat with that pressure by the US on China and also the reiteration of tariffs going ahead as planned against Mexico and Canada. Pretty poor session that we saw on Wall Street, so not a strong lead at all. The latest moves to curb US trade with China firmly in focus there. We are looking like some pretty hefty losses across the board. Sydney stocks looking like another session of losses off by just about 1/10 of 1% as we get into the start of the staggered session here. Chicago Nikkei futures looking pretty flat at this point as we have Tokyo coming back online after the Monday public holiday. Dollar yen is sitting just under that 150 level. Futures in Hong Kong also pointed to downside of about 2% there at the open with Shanghai. And of course here in Australia looking to continue that mood as well. Watching dollar China for any sort of reaction when it comes to the US-China mood music, if you will, particularly as we heard that the Trump administration also pressuring Mexico to put their own levies on Chinese imports as well. Taking a look at Alibaba, this was sort of one of the biggest proxies that we saw the reaction tumbling as we saw that further sort of China trade angst there. They fell 10% in the US trading session. Those ADRs there on the back of the latest executive order really stirring kind of deeper fears about these trade tensions between the two mega powers. Alibaba, though, has been up about 70% this year through to the Friday close, but a bit of a sharp reversal there. Let's take a look at how US futures are shaping up at the moment after what was really that lackluster session there. S&P futures just mildly in the positive. We are looking at oil as well as that price just edges a little bit higher as we continue to get the question mark over supply, the outlook there, and some of the peace talks, of course, that we're seeing really clouding some of the potential outlook certainties when it comes to crude as well. Well, President Trump says tariffs against Canada and Mexico are set to go into effect next month. He made those comments during a joint press conference with the French President Emmanuel Macron.
The tariffs are going forward on time, on schedule. This is an abuse that took place for many, many years. And I'm not even blaming the other countries that did this. I blame our leadership for allowing it to happen. I mean, you know, who can blame them if they made these great deals with the United States, took advantage of the United States?
Let's bring our White House correspondent Kate Sullivan. And Kate, so quite a bit of news out of the White House when it comes to tariff policy. It seems like the continuation, he says that this is progressing pretty rapidly.
That's right. So there are a lot of questions that remain about how exactly Trump's sweeping tariff proposal would be implemented and what that timeline looks like, when exactly these tariffs are going to go into effect. There was a bit of confusion at the White House today because Trump was asked specifically about the tariffs that he has promised to impose on Canada and Mexico. So these would be 25% tariffs that Trump says he's putting into effect because he wants Canada and Mexico to really step up and help curb illegal immigration and the flow of illegal substances, including fentanyl. But the confusion here was that Trump was asked specifically about these tariffs that you mentioned that are set to go into effect next week, Canada and Mexico, and he said the tariffs are going forward on time, on schedule. But after the press conference, a U.S. official told us that Trump actually wasn't referring specifically to those Canada-Mexico tariffs, that he was actually talking about a whole separate bucket of tariffs called the reciprocal tariffs. Those are still being ironed out. But again, the official says that the fate of the Canada-Mexico tariffs are still hanging in the balance. They still haven't been quite narrowed down. And these reciprocal tariffs are the Commerce Department right now is looking at the different rates for different countries. So big question mark there still.
Okay, there's some big question marks when it comes to some of these geostrategic relationships as well, right? Did we really kind of see any deliverables from that meeting with Emmanuel Macron?
The meeting with Macron was definitely significant. I think even just watching the two leaders up there, you could see a friendly rapport. This, of course, comes at a very important time as negotiations and discussions are intensifying over the fate of the war in Ukraine. But you saw the two leaders agreed on the deployment of European peacekeeping forces if there were to be a deal that is reached. But you also saw, stark differences between the two leaders on display here in terms of their approach to the Ukraine war and Putin. You saw Trump really express a desire for a ceasefire deal as soon as possible, saying that he's willing to go and meet with Putin. He wants to get this deal done fast. Macron was really urging a more deliberate approach where he was stressing the need for, he's saying we all want peace, of course, but there needs to be, any deal needs to be checked and verified and assessed. So you could see the two different approaches there on how exactly to move forward when it comes to the war in Ukraine.
Bloomberg's White House correspondent Kate Sullivan there. Let's get some more on that because President Trump says he's in very serious talks with Russia's Vladimir Putin about ending the war in Ukraine. That comes as Washington votes against a U.S. resolution condemning Moscow's invasion. Bloomberg's Michael Heath joins us now. So this really kind of continues to cleave the discord between the U.S. and the rest of the G7, really. This resolution and the way that the US voted, is it surprising given the context of what we've seen?
Well, it's not in terms of the context of what we've seen, but it's surprising nonetheless, Heidi. I mean, the truth is stranger than fiction here. The idea that the US lines up with China and Russia against the UK and France, two of its longest term allies, since the founding of the US in France's case, it's extraordinary. And so you saw the US lining up with Russia, with China. It voted on the side and voting also against this condemnation of Russia's invasion of Ukraine, together with North Korea and Belarus, which is a Russian ally, an old Soviet state. It's really extraordinary. I mean, on one hand, it's understandable because President Trump is trying to forge a new relationship with Russian President Vladimir Putin. So he's trying not to rock the boat there by unnecessarily aggravating Russia. And in what's basically, I mean, the UN is not going to do anything practical here. It's a lot of it is symbolic. But the symbolism also is stark because yesterday marked 3 years since Russia's totally unprovoked invasion of Ukraine. So, there was a strong argument to put the politics aside and just call a spade a shovel kind of thing here and say, Russia did invade here and, this is unacceptable and the UN is about sovereign rights of nations and, that's one of the reasons, one of the founding principles of the UN. But they've obviously chosen to try to secure, President Trump has to try to secure, these warmer ties with Russia in the belief or in the hope that will accelerate or get some form of peace process going. It's probably a bit of a dubious perspective because it is only symbolism, but it's the way they've chosen.
It's interesting. Trump said at the White House, I would rather not explain it now, but it's sort of self-evident. We heard from the former Treasury Secretary, Larry Summers, comparing this to the Treaty of Versailles.
Yeah, I mean, I think Summers was talking more about the
mineral aspect.
Yes, exactly. And I'm not sure Versailles is a particularly apt comparison. I mean, in Versailles, obviously the Allies put war reparations on Germany, which started the First World War. Whatever anyone says, that's basically what happened. Whereas Ukraine here is being forced to sort of pay up despite being the victim of aggression kind of thing. So perhaps it is worse than Versailles in that sense, and Summers is right. But yeah, look, they do seem to be moving a bit closer towards some sort of agreement here, which I guess seems to be positive that they're narrowing some of the differences. But the areas that remain are, again, Ukraine wanting some degree of security agreement there. The positive side is that this $500 billion that President Trump was saying that Ukraine owed the US has sort of been pushed to the side. Seems to be agreement that wasn't the figure. But they do seem to be making progress there. And there's even talk that Zelensky might end up in Washington this week for a signing ceremony. So we'll sort of just have to watch that. There's an interesting thing also that Bloomberg has very, very good reporters with good contacts in Moscow. And from the Russian side, President Trump's outreach is causing some degree of disturbance in the Kremlin because they don't really understand the strategy and they're thinking that perhaps there's some trap in all this sort of warmth. So it's really quite curious that they're struggling to follow what he's trying to achieve there as well. But one thing's also fairly clear is that President Trump was looking for the US is wanting some sort of ceasefire, some sort of progress with on the Ukraine-Russian talks to sort of get things underway, and Russia's doesn't seem particularly keen on that. And I think what we're seeing here is that President Trump is sort of seeing this as like, well, Russia gets land or this or that, Ukraine doesn't get into NATO. What he's sort of missing is that Russia wants a pliant Ukraine. Either it's neutral or it's a pro-Moscow government. It has a limited size military. It can't defend itself properly against Russia. It basically becomes, a pillow next to Russia kind of thing. And Ukraine's never going to accept that. And it's going to be very hard for the US to actually even impose that. So how you get an agreement there is very difficult to understand.
Bloomberg's Michael Heath there, and we are hearing in a Fox News interview from the French President Emmanuel Macron saying that he thinks it's feasible to have a truce in Ukraine, and he's also speaking about the timeline that could happen in the weeks to come. We're hearing now from French President Macron, who of course also in his meeting with President Trump at the White House urging for support for the Ukraine peace process by the US. Well, Bloomberg Economics thinks that President Trump is ushering a new world order, one which threatens global dislocations. Bloomberg chief economist Tom Orlick is with us. And, as Mike just mentioned, truth is really seeming like stranger than fiction in the time that we're living at the moment. And these fractures that you're talking about, these dislocations, we're seeing really around the world. If we start off with Europe, this sort of new military security regime that the US is sort of pushing for, how big of a shift is that going to be?
So I think this is an incredibly significant moment for the US, for Europe and for the world, Heidi. If we go back all the way to World War II, the US has committed to providing a global security guarantee to its friends and its allies, and it's also been a champion of free trade, which successive US presidents have seen as a driver of prosperity at home and a driver of prosperity globally. Clearly Donald Trump is not signing up for either of those missions. On security, he's advocating a do-it-yourself world. If you want security, invest in your own military or pay us. And on trade, clearly his view is that free trade isn't really working out for the United States anymore. So on security and on trade, the twin pillars of the US order, or the global order which the US built after World War II, they're being kicked away. You asked about the implications for Europe. I think they're pretty far-reaching. Europe has been, frankly, free-riding on the US security guarantee. Now they're going to have to start paying for it. That means trillions of dollars of additional borrowing to amp up military spending. And, of course, European countries like Germany, very significant beneficiaries of a relatively open trade relationship with the United States. If they're going to be facing tariffs, German auto firms already suffering from Chinese competition, tariffs from the United States certainly wouldn't improve their prospects.
It feels a little bit different to the first Trump administration, where we're seeing broad strokes in terms of nobody is sort of immune here, right? It's not necessarily just ire that's being targeted to Beijing. Where do you see the vulnerabilities around the world?
So I think there's a bunch of economies around the world, Heidi, that have been either beneficiaries of the US security guarantee or beneficiaries of having a significant trade surplus with the United States, which now find themselves facing some pretty significant challenges. So if we think about East Asia, think about South Korea, US military base to provide a deterrent against any adventurism from Pyongyang, and a massive trade surplus with the United States. Think about Taiwan, beneficiaries of the US security guarantee. Biden was pretty explicit about that guarantee as a defense against any adventurism from mainland China, and also an economy which runs a massive trade surplus with the United States. Think about Eastern Europe, NATO members which count on the US security guarantee. So if we look around the world, if we look especially at East Asia and Eastern Europe, there's a bunch of economies, pretty significant economies for the global system, which now find themselves in a potentially hostile neighborhood and without the big friend in Washington, D.C. that they used to be able to count on.
Our Bloomberg chief economist Tom Orlick there. Well, coming up on the Asia trade, PGIM Investments explains why it's time for investors to move out from cash. The CEO of Hong Kong electricity supplier CLP joins us too to talk through the firm's latest earnings. Plus, Swinburne University will be along with us to unpack Wisetech's power struggle, the implications for corporate governance in Australia. This is Bloomberg. Take a look at what we're watching when it comes to that FX reaction to some of the commentary we had from President Trump when it comes to the certainty or the rapid progress when it comes to Canada and Mexican tariffs going ahead as planned. We are taking a look at, of course, the loonie, really sitting pretty close to the day's low after those warnings on tariffs, and watching the Mexican peso as well. The Bloomberg dollar index not moving too much, but did also fall almost 0.5% to the lowest since December. Let's bring in Garfield Reynolds, who leads our Markets Live Asia coverage. So the move that we saw on the loonie and the peso, unsurprising. What sort of explains the dynamics of the US dollar moves at the moment?
Yeah, very much so, Heidi. Although in the longer term, the impact of tariffs on the US dollar is potentially more questionable. In the short term, investors are very much treating tariffs as something that, if they're coming, that's a US dollar positive, because the hit to other economies is seen as being stronger than the hit to the US economy, particularly if there are any if there's any reciprocation from Canada, Mexico, others that have had tariffs imposed on them. So we've had a situation where the dollar strengthened quite a lot between the election of Donald Trump and his inauguration, and then when his inauguration was not followed by immediate tariffs, or apart from that little on again, off again moment over that weekend in late February, the market has moved mostly to pricing in a lesser fear of tariffs, that if they're coming slowly, and they might well just be a negotiating tool, so they might not actually come in. So then when you have comments such as those overnight, which seem to indicate that some of the tariffs that have been delayed are now going to come in anyway, the knee-jerk response is mostly to buy the US dollar, especially against the loonie, against the Mexican peso. We also saw some weakness in the Australian dollar, which has shown plenty of sensitivity to the issue too.
The other thing I saw, obviously, was the big sort of sharp turnaround for Alibaba and the ADRs trading in the overnight session. There's been so much exuberance broadly, or just sort of optimism, right, when it comes to AI, DeepSeek across China tech. Is this sort of a game changer for that sentiment?
Well, it's one leg of what could be a game changer, I think. If you look at what's gone on in Chinese markets this year, it's been two key drivers. One has been a perception that Donald Trump, in his second presidency, is taking a softer line on China relative to what he did last time, and certainly relative to some of the things he said on the campaign trail when he talked about 60% tariffs. So far, we've only had 10%. So that's been one peg of it. The other peg has been the expectations that the Chinese government would help to support AI themes like Alibaba, and would help to, would supply stimulus. So we've got those major government meetings that are coming up next week. That is also a key input that might help to limit declines during Chinese trading today. We'll see. Dip buyers will certainly be tested by the extreme declines overnight in the Golden Dragon and in Alibaba. But at the very least, we can say that a more hostile approach from Trump and the US to China is going to put a speed limit on the Chinese stock market, even if it's not going to come to a complete shuddering halt unless we get another disappointment from the authorities in Beijing.
Garfield Reynolds, who leads our Markets Live Asia coverage there. Well, top of mind for investors, also the Bank of Korea expected to cut its benchmark interest rate by a 1/4 percentage point when the board convenes on Tuesday. For more, let's bring our Bloomberg economist, Hui-Sung Kwon, who has been taking a look at really the Bloomberg survey, right? All economists expecting a cut today, but the market seems a little bit less certain. Where is that gap? And have we seen an improvement from, say, December, where, of course, sentiment was really depressed, it was ongoing political uncertainty, the air disaster as well. Have there been any signs that perhaps the economic outlook has improved?
Hi, Heidi. Thanks for having me. So economic outlook is, as you mentioned, this is not so bright for South Korea's economy. But the rate cut today, I expect the BOK's rate cut today would push add another stimulus to the South Korea's economy, and also we are expecting for a supplementary budget in as early as in March, which could also add another stimulus to the economy. And what is more, the Constitutional Court is preparing for its final phase. So it is likely that we will have the Constitutional Court's ruling in March that will probably reduce the political instability significantly. And in that way, we could have some, better, some outlook improving.
How difficult could that outlook for 2025 and beyond be, depending on the impact that you see from Trump's tariffs and the sort of broader global trade tensions?
Trump is raising tariffs on steels and aluminum and potentially other products such as autos and semiconductors, which will hit South Korea's economy hard. That might lead to a slower growth this year, and then I think the downside risk is quite significant. At the same time, South Korea holds a U.S. Army here. But Trump mentioned that we need to pay more for the security, and that will lead to another hit for South Korea's economy.
Bloomberg economist Hui-Sung Kwon there. More ahead on the Asia trade. This is Bloomberg. Taking a look at some of the movers so far in the Aussie session, Woodside is one that we're watching. We're seeing a little bit of upside there. Net profit more than doubling as output there for the producer, rising to a record for LNG. So we are seeing just a bit of a positive reaction so far. This is Bloomberg. Take a look at, we are just about half an hour into the start of trade here in Australia as we look to a pretty muted session across Asia, really. We are seeing downside now being extended to 0.8% for Aussie stocks there as we get that risk-off sentiment with trade, global tariff concerns continuing to weigh. Broadly, Asian stocks are looking set for losses as we get into the start of trading in other major markets. Tokyo coming back online, indicating lower, as well as to Hong Kong a little bit later in the session as well. S&P futures a little bit positive there after what was a pretty poor session on Wall Street, particularly when it comes to some of the big tech, and we saw that big fall in Alibaba ADRs there as well. So certainly not the positive mood music as we get into this Tuesday session. Let's bring in some of those analysis when it comes to these ongoing risks now. Jessica Jones joins us now. Is the head of Asia at PGIM Investments. Jessica, really great to have you with us. And of course, Trump's policies, trade tensions was always always going to be one of the big 2025 themes. And time again, we see this kind of being revived. It is a risk-off day to day, but previously it feels like we've kind of had investors pretty happy to kick the can down the road, particularly when it comes to continuing to invest in the US.
Yeah, absolutely. I mean, you know, all these Trump policies and executive orders that we're hearing in the US, it's certainly creating a lot of headlines this morning and continues to have. I mean, there's just so much uncertainty in the market, and it's so hard for Asian investors to know what the end game is and what ultimately is going to happen as a result of all these headlines, whether it's going to end up causing more inflation or whether it's going to actually slow down growth. The jury is still out. But I think, you know, if bigger picture, what we're really seeing is that 2025 is still going to be a very compelling entry point for Asian investors. If you think about it, there's over $7 trillion sitting in cash and money markets with Asian investors, well, actually globally. And this is at a cost of something like 5% a year of lost returns. So when I speak to private bank CIOs and family offices across the region, we see, you know, despite all these headline news, they're really advocating for their investors to get out of cash and be invested in bonds, equities, and also continue to invest in alternatives where we see a great diversifier in these volatile markets.
You've got to be super selective in this environment, right? Is the idea to look for opportunities that are decorrelated to global macro and political risk?
For sure. I mean, our PGIM fixed income is really advocating that, you know, right now it's a bond bull market and there's an attractive yield to be had, but absolutely you need to be selective. You need to know what you're doing and you need to think about being in diversified portfolios. We're really advocating for being in a barbell strategy and multi-sector credit as well as global bonds seems to be the most attractive space right now. You know, we still see that fixed income, active fixed income is a crucial part of client investors' portfolios and offers stable income, but also downside protection when you see all these headlines. But yes, absolutely, you need to be selective and you need to be thinking about the duration prospects with your fixed income portfolios. So we are really advocating for shorter duration. We're seeing there's a sweet spot with Asian investors of really a gap needing something in that 2 to 3 year duration bucket. And actually this week we see one of the top 3 private banks in Asia actually allocate and launch one of our multi-sector credit portfolios. Despite them having a very crowded shelf with lots of different fixed income funds, they see that there's a gap and a need for their clients to be in that shorter duration 2 to 3 year bucket.
You mentioned alternatives still being very compelling. Is there anything specific, I should say, that you wanted to draw our attention to in terms of that space of opportunity?
Yes, global alternatives continue to be something that Asian investors continue to allocate to. I think we see something globally. There's $4 trillion invested by private wealth investors in private alternatives, and this is only set to grow in the next few years to over $14 trillion. So huge opportunity. Again, speaking about those CIOs, they're advocating 15 to 35% house views allocation to alternatives. And if you think about it, only 76% of investors are woefully under-allocated and may have an allocation of less than 5% in alternatives. In terms of where we see the brightest spots and the most demand at the moment, it's private credit. Private credit remains the hottest market. It's a market that's quadrupled in size in the last 10 years from 500 billion to 1.7 trillion is the latest numbers that we see. And we see significant untapped opportunities in that middle market, that core middle market segment of direct lending, and also in that non-sponsored part of the private credit market. The non-sponsored companies are those individual family-owned businesses where we see a huge amount of potential, lower leverage, and much more long-term investment horizons in those businesses.
How do you feel about AI? Because there's been sort of a new bright spot of optimism when it comes to China, and some of those players are kind of playing catch up when it comes to valuations at this point. But do you think there is a more sense of being discerning when it comes to AI, given the huge amount of investment that's already gone in?
Yeah, AI continues to be a big theme that our growth equity manager, Jennison Associates, continues to invest in. But again, you do need to be selective and think and be very agile and dynamic when it comes to investing in AI. Of course, the news that we've seen out of China with DeepSeek has caused a reappraisal of China tech from an AI perspective. But we're actually really excited about the developments there and how this may be causing more opportunities for emerging growth leaders to start emerging in the AI space. But in terms of sectors, definitely transformative technologies, fintech platforms, and healthcare innovation are areas that we continue to see interest from a growth equity perspective.
Jessica, really great to have you with us. Jessica Jones, head of Asia at PGIM Investments. Let's take a look at some of the other stories that we're following this hour. And according to Ukraine's Deputy Prime Minister, Olha Stefanishyna, Kyiv is in the final stages of talks with the US over giving Washington a cut of the country's natural resources. The draft deal, seen by Bloomberg, says the US will commit to a free and sovereign Ukraine and agree to a durable partnership between Washington and Kyiv. The Trump administration sees the deal as being an integral part of his plan to broker a ceasefire with Russia on its war against Ukraine. Germany's incoming Chancellor Friedrich Merz is said to have started talks with the Social Democrats to quickly approve a $210 billion emergency defence fund. Sources say Merz's bloc and the SPD are looking to get around Germany's tight rules on government borrowing to beef up the country's military. They're said to be mulling a vote before the new legislature meets in March. The Kremlin says Russian President Vladimir Putin has spoken about recent US-Russia contacts on Ukraine with Chinese leader Xi Jinping. According to the Kremlin, both leaders spoke via phone call on Monday. China has publicly welcomed direct communications between Putin and Trump, although it remains unclear what an improvement for US-Russia ties would mean for Beijing's relationship with Moscow. The UK is imposing sanctions on 10 China-based companies it says are enabling Russia's defence industry. According to the UK's Foreign Office, the move targets those supporting Russia's military regime and the supply network that it relies on. The sanctions are the part of the biggest package of economic measures against Russia since 2022 and also include some firms in Thailand and India. India's Commerce and Industry Minister says New Delhi has the flexibility to reduce its tariffs in a free trade agreement with the UK. Piyush Goyal met with his British counterpart earlier to revive trade talks after negotiations were put on hold due to elections in both countries. The UK is eager to complete an FTA and suggests that the deal is a top government priority. More ahead on the Asia trade. This is Bloomberg. Take a look at shares in Woodside, trading a little bit to the upside at the moment. In fact, extending gains now as we're about 40 minutes into the start of trading here in Australia, about 1.5% higher. The Aussie oil and gas producer network net income more than doubling for 2024. That met estimates. Bloomberg's Paul Allen joins us now. And it was a record year when it comes to production, but weaker prices.
Yeah, that's right. That did weigh on the result to a degree, but still a pretty strong set of numbers considering the circumstances. Underlying profit, $2.88 billion. That was pretty much in line with expectations. But yeah, sales revenue down 6% on lower prices. Woodside took an impairment charge on a couple of projects as well. The dividend, 53 cents. That was a bit less than the 60 cents of last year. Returning cash remains a priority for Woodside. Says this payout's 80% of the underlying net profit. But there might be some questions over the sustainability of that policy going forward. There are some big expansions coming up, a couple of projects in the US, the LNG project in Louisiana, an ammonia project in Texas as well. And notwithstanding today's bump in the share price, Woodside has underperformed the broader ASX, down about 24% on year, although it's reaffirming guidance in terms of production for the coming year.
One of the projects, as you allude to, that they're waiting on government approval on as well.
Yeah, the Northwest Shelf, this is a huge project. If approved, could see $30 billion worth of potential investment. It would involve 3 new gas fields, an enormous pipeline, 900 kilometres connecting to the Karratha plant in Western Australia, and it would expand the lifespan of that plant way out to 2070. But there's that usual tension, right, between jobs, energy needs versus the environment. There have been more than 800 objections to this project on both cultural and environmental grounds, and we're looking at everything through the lens of the election at the moment, not just federally by May the 17th, but also there's an election coming up in Western Australia. Nationally, the government's trailing, the West Australians reporting that the Greens and the Teals might support a minority Labor government if it cancels this project. So big question mark hanging over that project for Woodside.
Bloomberg's Paul Allen there, and we'll hopefully get some more answers when it comes to those question marks. And on those earnings, we have an exclusive interview with the Woodside CEO and Managing Director, Meg O'Neill. That's at 2:05 p.m. Sydney, 11:05 a.m. if you're watching in Hong Kong. The latest from the corporate front now, an AI startup, Anthropic, is said to be nearing a deal to raise $3.5 billion, larger than initially planned. The funding round would value the company at almost $62 billion. Meanwhile, Anthropic also released a new AI model called Claude 3.7 Sonnet that lets users choose how much time the AI spends computing an answer to a question. Microsoft has cancelled some leases for its US data center capacity. While the reasons remain unclear, TD Cowen suggests it may be due to an oversupply position. While Microsoft reiterated that it plans to spend $80 billion on AI data centers this year, the cancellations have raised concerns if it's securing more computing capacity than it needs. Bloomberg has learned that Tesla is preparing a software update for customers in China that will offer driver assistance capabilities similar to full self-driving in the US. The system is expected to guide vehicles to exit ramps and intersections, recognize traffic signals, make turns and handle changing lanes and speeds. The capabilities will be deployed to customers in China who've paid close to $9,000 for what Tesla calls FSD. Starbucks shares closed higher after the firm moved to cut over 1,000 corporate jobs in a bid to increase efficiency and revitalise the company. The cuts represent about 7% of their global employee base working outside of company-owned stores. Workers affected will be notified by Tuesday. The corporate employees have been asked to work remotely the whole week. Well, Apple says it will hire 20,000 new workers and produce AI servers in the US. The tech giant is seeking relief from President Donald Trump's tariffs on goods imported from China. Let's bring our senior editor for technology, Nick Turner. So, Nick, what do we know about this, and how much does it address this threat that is coming from this administration?
Well, it's hard to tell whether it's actually going to avert the issue that I think Apple's looking to avoid, which is obviously the 10% tariff on merchandise that's coming from China. Last time Trump was in office, of course, Apple was able to avoid major tariffs, and it sort of kept plugging along. And I think the hope is to do that this time as well. And obviously, this pledge, this commitment, is potentially going to help with that.
And we have seen Tim Cook meeting Trump in the Oval Office and sort of engaging on that level. Do we know what sort of communications and perhaps negotiations are taking place right now?
I mean, they had that meeting. Trump said it was a fairly lengthy one, so I'm sure they discussed a lot. I mean, Trump made some comments last week about what Apple's plans were. At the time, it was a little unclear. Obviously, we have more clarity today in terms of what they're looking to do. Now, it's worth noting that this is only kind of a somewhat of an increase over what their spending plans had been already. The symbolism, I think, is important when you look at having a new server facility in Houston and another facility in Michigan. But the essentially in terms of how much they're spending and how much they're hiring, it's not a completely dramatic increase from what they've been doing.
It's interesting because Tim Cook was able to sort of successfully argue against these tariffs for Apple in the first administration, right? One of the arguments was that actually we're going to give an advantage to some of Apple's competitors like Samsung. Do you think that consideration would still hold sway?
I mean, it still seems like it makes sense. I mean, Samsung, less manufacturing done in China, so it's not subject to that tariff, at least. If other tariffs are imposed that maybe will affect Samsung, then maybe that's a different conversation. But at this point, it does seem to give an advantage to Samsung, which of course is the Apple's biggest rival in smartphones.
How big a challenge, if the tariffs are implemented and if that is a cost that consumers are going to have to see, how much an impact will that have on demand for Apple's products and for iPhones? Given that we know certainly, in the Chinese market it's been a little bit slower, but elsewhere, is there the level of resilience that can sort of take that?
I mean, ultimately, if Apple can't avoid this tariff, it has a decision to make, which is either raise prices or have smaller profit margins. Typically, they haven't really made price decisions off of these kind of issues. They did just come out with a new version of their low-end iPhone, which is a good bit more expensive than the prior one. So you could almost consider that a price increase in its own way. And so maybe that's a step towards having higher prices overall. But essentially, that'll be sort of the decision they have to make.
Bloomberg Senior Editor for Technology, Nick Turner there. More ahead on the Asia trade. This is Bloomberg. We are taking a look at the PPI numbers when it comes to Japan that have just crossed the Bloomberg there. Services year on year for January rising 3.1%. That is bang in line with expectations and rising from that previous period of 2.9%. That revised number coming in at 3% there. And we have been watching what's going on when it comes to the yen. Volatility sitting at that 6-week high. The yen has been sort of a little bit softer against the dollar after the long weekend. Really watching for sort of pieces more of this inflation story to see if it adds to rising inflationary pressure, as we've seen that sort of acceleration for price pressures in Japan. That CPI number for January being driven by higher food prices that we had sort of a few sessions ago. Consumer prices seeing that rise even when you exclude fresh food as well. So really kind of keeping the Bank of Japan on that rate hike path. They're expected to raise interest rates further, with economists now expecting that next move to come around July as that price pressure momentum continues to build. Well, Japanese markets are set to reopen after the public holiday at the start of this week. Our Bloomberg Japan stock reporter Alice French joins us now to take a look at what we're watching out for. And certainly it is a downside day for sentiment for Japanese investors and Japanese stocks, I should say, to be rejoining the fray.
Morning, Heidi. Yes. So we know that Japanese markets will obviously have to catch up on 2 days of trading in the US. We've seen some falls over the weekend, particularly in tech, and I would expect that that'll be reflected here too. Also, like you mentioned, obviously all of these signs of inflation pointing to further hikes by the Bank of Japan, which have already been weighing on the market so far this year. Like you mentioned, we've seen the yen strengthening. That's obviously not great news for exporters, and Japan's benchmarks have been underperforming a lot of other global markets, and yeah, today will probably be similar along those lines. I would think we will see some falls today.
What about the Warren Buffett effect, right? We're hearing that he plans to increase ownership across the 5 big trading houses. We've seen sort of previously how that's been a real boon.
Yeah, absolutely. So I do think trading houses will be a bright spot today. As you mentioned, Buffett in his shareholder letter over the weekend mentioned that he's planning to gradually increase his holdings of these 5 trading houses. So he went public with those holdings in 2020, said that they would only be looking to invest up to around 10%, but that he's now in conversation with the trading houses to increase that. Now, we know that Buffett's holdings have been a boost for trading houses in the past. They have outperformed the benchmark since 2020 when he went public with those holdings. And so I would imagine that that will be a boost for them today as well. They are also impacted by a stronger yen, and so they are really in need of some help. And I'm sure that traders will be looking to trading houses and the boost that they might give to the overall market today on an overall down day as well. So it'll be interesting to see how that plays out.
We've seen really sort of that broad reaction when it comes to, again, these renewed tariff threats, right? Are we expecting that to play out when it comes to sentiment?
Yeah, so there's kind of some discussions going on as to what extent those tariff threats are priced in here in Tokyo. We know that obviously they have been negatively affecting things like car makers, tech makers. Obviously the risks are there and likely they will continue to be shown as the tariffs actually become implemented. Having said that, we know that Prime Minister Ishiba had a pretty smooth, pretty positive first meeting with Trump earlier this month. And so there is some optimism that Japan might actually be kind of a relative safe haven once all of these tariffs come into play. We know that Japan is in conversation with the states to try and get some kind of exemption, particularly on those car maker tariffs. And so traders will be looking to see sort of how much, to what extent can Japan kind of potentially be performing slightly better than some other global markets. But certainly, every time that Trump comments on these tariffs, it is a downward pressure for the market. And I would imagine that, exporters will probably be feeling that today as well, along with the yen, as you mentioned.
Yeah, Alice, what are strategists kind of, it's difficult to forecast in this environment, right? But what's the view for the rest of the year?
Yeah, so look, like I mentioned, Japan has not been doing so well year to date. It's underperforming the US, it's underperforming a lot of European markets. And obviously, the BOJ's rate hikes are a big pressure, particularly as we're seeing rate cuts in several other global markets. But, traders are looking for some signs of light going forwards. Of course, we're going to have the wage negotiations announced next month. People are expecting there to be record increases in wages, and that might help push consumption, and that would be a boost for the market. Also, of course, we do have the ongoing, development of these corporate governance reforms. We're seeing more M&A, we're seeing more activist interest, we're seeing, more buybacks and dividends, and those are all positive signs for investors. So there is a lot of optimism too.
And Bloomberg Japan stock reporter Alice French there as we count down to the reopen after that long weekend in Tokyo. The market open on Bank of Korea decision day in Seoul is also next. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens and the reaction to that sell-off that we saw on Wall Street with the S&P 500 breaking below 6,000. And of course, we have been reacting to the continued tariff threats from President Trump on Canada and Mexico, expected to go ahead as planned next month. And of course, we had the latest executive order, Haidi, targeting China.
Yeah, it will be very interesting to see that reaction across China tech. Alibaba, of course, in the ADR session falling and really signaling potentially, is this the sort of breaking point when it comes to some of these China stocks, in particular Alibaba, that has gained so much as part of this, China AI DeepSeek driven recovery.
And the Japanese market now opening after a long weekend, and we are seeing the Japanese yen trading at that 149 level, very close to that 150 level. Volatility has been high, near a 6-week high for the 1-month volatility, implied volatility index. This, of course, as we got the services producer price numbers for the month of January rising in line with expectations, 3.1% year on year. We'll be watching some of those stocks where Berkshire Hathaway is looking to increase ownership. We're talking about some of the largest trading houses, and you can see the 10-year yield holding at that 138 level as we continue to see that upside as the BOJ continues on its tightening path, but the Nikkei falling more than 1%. Take a look at how the Kospi is also coming online. Big day as we have the Bank of Korea rate decision, the expectation for the central bank to resume its easing cycle. The Kospi fell in the previous session. The Korean won at around that 1-month high against the U.S. dollar. We'll be watching what Governor Chiang says. He was calling for more fiscal stimulus when he spoke to Bloomberg earlier this month.
Shery, we are seeing trading just underway for about an hour or so. It's a bit of weakness there still coming through from Australia. We're off by about 0.9%, really tracking the losses that we saw in the week session on Wall Street in terms of some of the laggards. It really is the banks that are leading some of those losses there as well. We're also seeing downside over in New Zealand. We're watching sort of some of the oil-related names there as we continue to kind of see that rise in oil prices there after the Trump administration imposed new sanctions on the flows of Iranian oil. So potentially we see a little bit more concern on the supply side there as well. But of course, front and centre, really these tariffs that are being now reiterated as being on the way by President Trump. Shery.
Yeah, President Trump saying that those tariffs against Canada and Mexico set to go into effect next month. He made the comments during a joint press conference with French President Emmanuel Macron.
The tariffs are going forward on time, on schedule. This is an abuse that took place for many, many years. And I'm not even blaming the other countries that did this. I blame our leadership for allowing it to happen. I mean, you know, who can blame them if they made these great deals with the United States, took advantage of the United States?
Let's bring in Bloomberg senior editor Derek Wallbank as well as Garfield Reynolds, who leads our Markets Live Asia coverage. Of course, all of these risks, whether political or also on the China front, are leading to these market moves. But Derek, let me start with you, because are we going to see any deals coming with Mexico or Canada ahead of the tariffs?
Well, there's a week left to go, and a week is a very long time these days, right, in a world of increased volatility. Now, Trump was speaking there about the potential for tariffs to actually snap into place on Canada and Mexico. The White House later cleaned that up a little bit, said that it's not necessarily firm. There could still be negotiations in place there. Bear in mind, there are a lot of tariffs that are in the offing over the next, let's say, month to 2 months. So there's a lot to sort of keep in the mind as we go through there. One of the pushes, as you mentioned, is the idea for Mexico to have tariffs on China. Part of what that would do is that there has been a significant rise over the last couple of years in Chinese companies finding Mexican places to base that are somewhat near the border, go into Mexico, have goods that then are labeled as being from Mexico, go into the United States, and in that way kind of get around whatever might be a trade blockage between the U.S. and China. So the idea there is that if Mexico has its own block, then that sort of pathway either closes or limits or in some other way becomes more expensive, and that gets in there. But the idea that Mexico is looking at doing this at all is a significant signal to how seriously they are taking the threats right now. 25% tariff on goods in from Mexico and Canada would be a significant trade implement given the highly interconnected supply chains between those three countries.
Garth, to date we've seen a degree of complacency from investors. Is this about to change?
Well, I'm not sure that it is, Heidi, because part of the difficulty, what encourages investors to be complacent is the lack of clarity about what's going to go on. And what we've had overnight, at first it looked like it was clarity. Trump saying that these will definitely go ahead. Then we had a White House official speaking on condition of anonymity saying, no, the Mexico and Canada schedule is not certain, but yes, tariffs on everything are still scheduled to go ahead in April, all of which leaves things very much up in the air. So there's perhaps a theme of investors reluctant to price for the worst, because when they moved to price for the worst, they then rapidly had to unwind those positions. So I think that's part of what is driving that complacency. I do think equity markets look too complacent, especially because there are signs that the tariffs the tariff discussions and the uncertainties surrounding them are already having an impact on a range of economies, including the US's. We had the Dallas manufacturing survey crashing down to a negative territory unexpectedly in a release out overnight, and businesses there cited a big increase in uncertainty as part of the problem. We've also had aluminum tariffs spurring companies like Ford Motor and Coca-Cola to raise concerns about what that's going to cost them. And in fact, if you look into it, the premium that US companies are paying in order to get Canadian aluminum is already higher. It's not as high as it would be if there was a 25% tariff, but it's higher than it was before aluminum tariffs were seriously put on the table. So you've got a situation where cost pressures are growing and growth indicators are starting to slow just because of what's being talked about when it comes to tariffs and also the uncertainty regarding that.
And Derek, at the 3-year mark of Russia's invasion of Ukraine, we have the US withdrawing its condemnation of that. You know, we spoke about it earlier, and our colleague Michael Heath said sometimes truth is sort of stranger than fiction. At this point, though, given the direction of travel, it's not at all surprising.
Well, I mean, I think it was certainly a shocking moment in the United Nations to see the U.S. and Russia voting on the same side of any resolution with regards the Ukraine war. Now, what this does sort of signal, I think, is the plain fact that the U.S. negotiating position on Ukraine is manifestly different than it was, just 2 months ago with Joe Biden as president. So this is going to be, this is a new reality. This is a new sort of way that we're setting up as the Trump administration tries to bring a rapid end to the war. This is where I was focused so much on what Emmanuel Macron was doing today in Washington, meeting with Trump. Macron has positioned himself as a go-between between Europe and the United States and Zelensky himself, sort of in what might be a one-man kind of building a bridge to a seat at the table. Europe has been adamant that it must have a seat at the table, especially as it's going to get called on to provide any number of additional security guarantees, because the United States does not appear like it is going to be the guarantor of security in Ukraine, at least the militarily guarantor of security in Ukraine. It has talked about being an economic guarantor of security. But I've spoken with a range of European diplomats in Asia over the last week, and many of them have told me that they are an inevitable part of the talks because of that guarantee, and also made very, very clear that they are going to have a say in the outcome if they are going to be expected to play a part in Ukraine's security. Furthermore, you have heard comments out of Germany recently. Friedrich Merz, the winner of the election there, basically saying that Europe has to prepare as if it's going to have to step up anyway, because the U.S. is making very clear that it will not maintain the ancestral role that it has in securing the peace in Europe. That's just whether you like it or you don't like it. That's the way that it is, and people have to respond to that reality.
And the reality is that the geopolitical risks are also affecting, of course, market moves. Garfield, we have seen this fracture between Washington and European allies, and this will have implications when it comes to Washington targeting Beijing as well. Already we saw Alibaba fall, 10% overnight on the latest executive order. What more are we expecting when it comes to the market reactions from all of these Washington actions?
Well, when it comes to China, one of the questions is going to be whether Chinese investors are as worried as US investors were apparently by the latest moves out of the US. Those came over the weekend, and during the day yesterday, there wasn't much concern expressed. There was some concern expressed by the price action that was going on in Hong Kong and on the mainland, but nowhere near what happened overnight. So we'll see whether that drop is regarded as a dip buying opportunity, especially with the potential that Beijing will add some more stimulus at the meetings that are going to take place next week on policy and the government outlook. When it comes to the more the wider question, especially with regards to Ukraine, what goes on with that. There's some signs that, in fact, there's almost relief, as it were, that Europe is being forced to face up to what had been a developing situation where the US was signaling it wasn't that happy, even under Joe Biden, at the level to which it was having to carry things when it came to European defense. So that's been something of a positive. I think also something of a positive is the anticipation that whatever the ups and downs might be of the process, we are moving closer to something that could lead to peace in Ukraine. And that has been perhaps an unappreciated burden for European assets. And I think it was noticeable overnight that even when the tariff news broke about allegedly Mexico and Canada, the euro was resilient. It didn't really move down in the way that, say, the Australian dollar moved down, as well as the loonie and the Mexican peso. So Europe is looking like it would appreciate some sort of peace in Ukraine, however that might be achieved.
Bloomberg's Garfield Reynolds and Derek Wallbank there with the latest on all of the geopolitical moves and market moves that we're following today. Take a look at some of the action in the Japanese trading session, because we have trading houses jumping today. This one news that Berkshire Hathaway is looking to increase ownership in Japan's 5 largest trading houses, quote, over time. This according to Warren Buffett in an annual letter to shareholders. Trading houses have agreed to relax a 10% ownership ceiling moderately as Berkshire approaches the limit. And you can see that huge run-up in the topics since Berkshire Hathaway disclosed their stakes back in 2020. But of course, what's interesting in today's session is also that despite the fact that you're seeing those big moves in these trading houses, the broader market, Heidi, right now is under pressure, with the Nikkei falling more than 1%.
And of course, we are watching Korean assets today, with the Bank of Korea expected to cut its benchmark interest rate by a 0.25 percentage point when the board convenes on Tuesday. Let's bring in our Bloomberg economist, Hwee-Sung Kwon. And so when it comes to the survey, unequivocally, we're expecting a cut today, according to the economists that we've spoken to. But the market seems less certain. Where does that sort of disparity in expectations fall?
Thank you for having me, Heidi. The gap between economists and the markets comes down to how each view different risks. The markets are more focused on financial stability risks, especially the one's movement. If a rate cut leads to another sharp dive in the Korean won, it could trigger capital outflows and tighten financial conditions. Economists focus on the weak economy. And I think the case for cut is quite strong. So inflation is under control, but consumer and business confidence are weak, hurting the domestic demand. Exports are slowing, and then Trump tariffs pose additional risks. BOK posted in January to avoid putting more pressure on the weak one. But now that currency stabilized in recent weeks, I think the BOK is feel more comfortable cutting rates this time.
Yeah, the Korean won at that 1 month high against the US dollar, but we're still talking about the 1400 levels. I mean, just a few months ago, 1400 was sort of unthinkable. So what will you be watching out for in today's decision in order to sort of get a sense of the rate outlook for the rest of the year?
Well, if the BOK cuts today, I think it likely means the BOK is staying in an easing cycle, but move carefully. As you mentioned, Shery, that the BOK also cares about the financial stability stemming from the weak one. And I expect 3 more cuts this year, which will bring the base rate to 2% by year end. Unless the Korean won takes a sharp dive, if the BOK holds this time, it's quite unlikely, I think. But they may be waiting for more data or signs of stabilization in the currency market. But anyway, the direction is toward lower rates. I think it's just a matter of timing. Yeah.
Yeah, we'll be watching for President Trump's tariff threats as well and how that could really factor into the BOK's thinking. Hyo-sung Kwon, thank you so much for that, our Bloomberg economist, and we'll bring you that decision live when it happens, potentially within the hour. More ahead. This is Bloomberg. Hong Kong-based utility CLP reported results for the full year. The company's net profit rose 76% from a year earlier to 11.7 billion Hong Kong dollars. That was lifted by a stronger performance from its operations in Australia, while its business revenue in Hong Kong posted a decline. Joining us now is CEO T.K. Chiang. T.K., good to have you with us. So you saw that material improvement in your Australian business. First of all, what's driving those results? And are you still considering M&A options when it comes to Energy Australia, given now the recent more encouraging numbers?
Yeah, good morning. Yeah, CLP in 2024 achieved solid results, and we also have a significant growth in our non-carbon investments. Yeah, it's mainly because of the significant improvement in our Australian business. Now, in Australia, because we have carried out refurbishment projects in our power station and also improved the coal supply to our Mount Piper power station, so our generation portfolio in Australia improved quite significantly. And it deliver solid result, enabling a good financial results. Now, going forward in Australia, I think it all depends on the wholesale price in Australia. Right now, our forecast is that it's quite stable, despite that it might soften a little bit this year. But there are also some other factors that may affect the results in this year, because last year there were a number of one-off items, for example, the coal compensation payments, and we also achieved quite good result in our retail hedge book, which is uncertain this year. Now, regarding the partnership, because for CLP as a group, we have the Climate Vision 2050, so we have quite a significant capital requirement. We want to focus on our core markets in Hong Kong and China to help decarbonize these markets. So in other markets, we will basically carry out a self-funded approach. So in Australia, we are looking for partners. It could be on a project basis or it could be on a enterprise level, and we are open-minded about it.
Are you giving any considerations to the changing winds when it comes to a political push towards more clean energy, whether it's coming from the U.S. or the rest of the world? When it comes to, you mentioned your coal investments, but of course, clean energy assets.
Yeah, in all our markets, in CLP as a group, we have the Climate Vision 2050. So we want to achieve net zero emission by 2050. And on top of that, we will also exit coal by 2040. So we will adopt the same strategy across the whole, the group in different markets. For example, in Australia, we already committed to retire our Yallourn power station in mid-2028. And we are now focusing on developing flexible capacity because of the proliferation of renewable energy in the market. And we want to leverage the flexibility of, for example, battery storage in order to benefit from the volatility in the market.
When it comes to data centers and EVs, how is that affecting your business, particularly when it comes to Hong Kong?
Yeah, data center, I think everybody is now focusing on, the powerful functionalities of AI, different opportunities, and we do see significant growth opportunities. For example, in Hong Kong, last year, the overall growth in electricity consumption is about 2.1%. But if we look at data center in particular, this sector, we did see more significant growth, up to 8.6%. So in terms of the total amounts, data center consumption already amounts to about 5.7% of the total consumption in Hong Kong. And we do see the trend will continue. So in particular, in Hong Kong, we fully support Hong Kong government's policy in developing, for example, Northern Metropolis into a technology hub, and there would be more and more data centers in Hong Kong. Likewise, I think in other markets, we also do see similar trends. And in particular, for data center operators, they are looking for green power. So it aligns with CLP's strategy. So we focus on developing non-carbon investment, in particular like renewable energy, wind, solar, and sometimes we also invest in battery storage. And that will align with the overall strategy. And we do see the demand for clean energy is increasing.
How much demand do you see out of China, and how much potential to grow is that market for you still?
Yeah. Last year, I think the overall electricity consumption growth in China is about 6 to 7%. And this year, I think it's more or less, our view is more or less the same level. But I think more importantly, it's not about the overall consumption, but about the amount of renewable energy requirements in China. For example, last year, the total renewable energy investment in China is more than 300 gigawatts, which is even more than the total renewable energy investment around the world outside China. So you can see opportunities is very significant. Now, from CLP perspective, our target is to double our renewable energy portfolio in China with, in the medium term. So by 2029, our target is to reach about 6 gigawatts from currently about 3 gigawatts. So our target actually is quite modest in China. So we're looking for really good projects.
Given what you're telling us right now and the encouraging signs from your business, do you have a dividend payout ratio in mind at this point for this year?
Yeah, because of the dividend policy of CLP is to have a more consistent dividend, and at the same time, provided the underlying business can continue to grow, then we'll consider a steadily increasing dividend. So at the end of the day, the dividend will be decided by the board, and it will depend on the underlying performance of our portfolio.
T.K., always great to chat with you. T.K. Chiang, who's the CEO at CLP. More ahead on the Asia trade. This is Bloomberg.
Nissan, one of the big laggards in today's Tokyo session. Worst day since February 3rd. Of course, Moody's just cut Nissan's credit rating to speculative grade just a few days ago. But also, we have, of course, seen the tariff threats continue from President Trump on Mexico and Canada. We know that a lot of Asian car makers are exposed to either Chinese sales or also just making these vehicles out of Mexico. So all of these tariff threats are not boding well for Nissan, whose potential merger talks with Honda had also ended earlier this year. This is Bloomberg.
Take a look how futures in Europe are opening at the moment. Of course, it's been a pretty seismic a couple of trading sessions when it comes to the really processing the reaction to the weekend's German election. And now, of course, these developments when it comes to peace negotiations with Ukraine and the expectations, of course, when it comes to Europe. This is what we're seeing at the moment. Euro Stoxx 50 futures off by just about 0.4% there. We are also seeing German DAX futures also a bit softer. It is broadly risk off that we're seeing in terms of the Asian session, these tariff and sort of counter tariff and ongoing pressures on China as well, causing a lot of concern and certainly risk aversion. Shery.
Yeah, Chinese President Xi Jinping also has spoken again with Russian President Vladimir Putin. This coming at a time when the U.S. is also increasingly embracing Moscow, this as it tries to broker a ceasefire in Ukraine. Our chief North Asia correspondent Stephen Engel joins us now from Hong Kong. So, Steve, it really seems like we're witnessing this sea change in terms of the global world order right now. And now we have this awkward triangle between China, Russia, and the United States.
Yeah, that's a good way of putting it. It is an awkward triangle, given the fact that the White House, the current White House position towards Russia is a stark contrast to the Joe Biden administration. So there's a lot of unwinding of what the Biden administration put in as it relates to Vladimir Putin and Moscow, and it's now 3-year war in Ukraine. So this is an awkward triangle, as you see the three gentlemen there. And this phone call between Xi Jinping and Vladimir Putin can be read in a number of different ways. The Kremlin, as well as Chinese state media, has simply said that it was a welcome one that allowed Vladimir Putin to explain to Xi Jinping the nature of the dialogue that he's had with Donald Trump. But there's much, much more to this, obviously. Insiders in Washington and observers of this are calling this perhaps a possible, reverse reverse Nixon. Obviously, in 1972, the United States had rapprochement towards China, seeing a wedge opening up as difficulties arose between Beijing and Moscow. Others are now seeing this potentially as Putin's, Trump's courting of Putin perhaps is a chance for a wedge between Moscow and Beijing. So I'm getting into the weeds here of this three-way relationship that is obviously at the cornerstone of the efforts to bring some sort of negotiated peace in Ukraine, which is not going to come easy.
Steve, it's been really interesting looking at some of the reporting and sourcing from within Russia, right? Because even the Kremlin seems a little bit caught off guard by Trump's embrace of Russia and of Putin. Is there a conviction there that this is genuine, or is there some suspicion as to, what's really going on here?
Yeah, I think there is some suspicion. The Cold War legacy is still there, and the suspicions are still there. And sources within Moscow have told Bloomberg News and others that the Kremlin is a bit wary of this overture, worried about possible traps from the White House. So there's a lot of political intrigue, no doubt. And this also sort of alludes to China's position and its outward projection of saying that they welcome the dialogue between Putin and Donald Trump if it leads to a lasting peace in Ukraine. However, we can read between the lines as well as what has been reported, Xi Jinping telling Russia, essentially telling Putin that China and Russia are true friends who have been through thick and thin together. So clearly Beijing is, while publicly saying that they welcome these talks between Trump and Vladimir Putin, they are wary, about the possible ramifications of Moscow and the United States getting closer together and acting, if you will, as a wedge. So we'll have to see how this plays out. Clearly, as we saw in the vote in the United Nations General Assembly, with the United States essentially withdrawing its condemnation of the war in Ukraine 3 years ago, and also siding with Russia and not backing that European-backed resolution on essentially the third anniversary of that invasion of Ukraine by Moscow.
Our Chief North Asia correspondent Stephen Angle there. Let's take a look at how this session in Asian markets is playing out. Of course, quite muted given the declines that we're really tracking on Wall Street. Again, these tariff concerns, these worries for global trade, particularly the targeting of China, as we see how that played out when it comes to stocks like Alibaba as well, is really at play here. So some broad declines that we're seeing, about 35 minutes since the start of trading when it comes to Korea and Japan. Japan also sort of catching down from yesterday as well with that public holiday. The Nikkei 225 down by 1.4% there. We do have a standout when it comes to Japanese trading houses, though, including the likes of Mitsubishi, Marubeni, Itochu, Warren Buffett looking to boost those stakes, and pretty expected that we're seeing that rally there. As I mentioned, Alibaba shares tumbling in US trading on Monday. President Trump's latest executive order stirring fears about deepening trade tensions between the US and China. Let's bring our China correspondent Min Min Lo. So we did see that reaction in ADRs. Having said that, we have seen a pretty impressive run-up for Alibaba. I guess the question is whether this is enough to kind of, structurally take out the wind out of the sails of this China tech and AI-driven rally that we've seen over the past few weeks.
Yeah, it looks like we're starting to see this souring of sentiment here because it's not just Alibaba. You look at Kingsoft, Bilibili, all of these tech stocks down about 10% in the U.S. session overnight, dragging down that Golden Dragon Index, which was down about 5.2%. Every single stock in that index, except for 3, closed on the downside. And this is in response to Trump's latest trade salvo, tightening the screws on Chinese investments into U.S. critical sectors, including the tech sector, mineral sector, among others, and also looking at potentially new restrictions, investment restrictions on U.S. funds to invest in Chinese tech, which could again curtail China's AI supply chain, affecting internet companies, hardware and software companies, plus also mulling this additional fee on Chinese-built chips, which could again affect e-commerce, trade. The likes of Alibaba, JD.com, Shein could be affected, and also reviving fears around these accounting standards of foreign firms, because that memo talked about how U.S. plans to tighten scrutiny and enforcement of these rules. And if you recall, back in 2022, that was precisely the issue that threatened to delist some of these Chinese companies in the U.S. So all of these fears now getting priced back into the market. What I find really interesting, though, is the dichotomy between how Chinese investors are viewing this versus U.S. investors, because you look at how Alibaba traded yesterday in Hong Kong, it was down only 2% versus 10% down on the US ADR. So quite a split in the views here. But of course, looking at how Chinese mainland markets will open later, and also here in Hong Kong as well, we're bracing for volatility, possibly hefty losses following through on the session in the US. And again, the question is, how sustainable is this shift in sentiment? Is it going to lead to a turn towards a bear market on these Chinese equities? That's something that we want to keep a close eye on.
And what's been interesting is that despite all of this, we have seen resilience in the Chinese yuan, a lot to do with authorities just defending the currency, but that's having some unintended consequences.
Yes, so the PBOC has been defending the yuan, and it's been withdrawing liquidity from the financial system with most of its daily operations so far this month. And what that's doing is that it's pushing up the interbank lending rate. So banks are now preferring to hoard their cash rather than lend to their neighbors, to their rivals, through these repurchase agreements. And that situation is further worsened by local governments borrowing more to refinance their off-balance sheet and hidden debt. And so what we're seeing now is this is showing up in this melt-up in yields across the curve. The 10-year bond yields now at the highest since December. More than half of the bond funds in China sitting on losses year to date so far, and that outflow also threatening to feed into this negative feedback loop there. And so let's see what the PBOC would do, whether they would soon move to shift their stance here, because the PBOC governor did pledge that they would loosen monetary conditions. But again, it's this competing priority between supporting the yuan on the one hand and loosening monetary policy on the other hand. And it's possible the PBOC is still reserving some of that firepower for more effective easing measures when they feel that the tariff risks are more acute. So something to watch on when exactly the PBOC will start shifting its stance there.
Bloomberg's China correspondent Min Min Lo there. We do have more ahead on the Asia trade. This is Bloomberg. Take a look at Wisetech, which of course has had a challenging few sessions after the founder and largest shareholder Richard White had earlier looked to have triumphed in a sense in this ongoing high-level power dispute, but of course that comes after almost every board member quit in a disagreement over his role at the company, including its chairman. So we saw 4 out of the 6 directors to leave on February 26 following a statement citing intractable differences in the board and differing views around Richard White's position. Joining us now from Melbourne is Helen Bird, who's a senior lecturer of law at Swinburne University and focuses on corporate governance. Helen, really great to have you with us. And for a market like Australia, how unusual is this situation?
Well, very unusual, certainly for a publicly listed company. It's not unknown to have an internal spat for the occasional director to resign, but never en masse like this, including the chairman at the same time. So, yes, it's really quite unusual.
And as I sort of alluded to in the introduction, this could be spun as, you know, as a victory for Richard White, given how long this has sort of been dragging out. But when it comes to stakeholders, when it comes to shareholders, what are the implications going forward?
Well, yes, I think you could argue that as the founder of the company, he could look at this and say, well, I've resumed control of the company. It's not clear yet what position he's going to take post the announcements on Wednesday, but I would not be surprised if he put himself in as some form of chairman. I think that if you're an investor in the corporation, whether a large investor like an institution or a retail investor, you should look at this with some horror, because there have been clear issues going on there and he's taking control. Yes, he is the, you know, magic and the brains behind what they've achieved, but equally there are some findings there that have simply not been satisfied. And the way we try to check against that sort of self-interest from continuing in a company is we appoint independent directors, and every single independent director, including the chairman, has resigned. So flouting the, what do we call the practices and recommendations of Australia's corporate governance rules. And just from that point of view, you should be wary. No institutional investor is going to be happy with that arrangement.
This seems, you know, I think when this sort of unfolded in October, right, when he was forced to step down, string of allegations of misconduct, the, you know, board review of governance and looking into the behavioural standards that have sort of arisen from some of these accusations as well. Is it kind of shocking that this is where we've ended up? And as you say, this is sort of the, you know, if it's a choice between corporate governance standards and talent, clearly the latter has won out here.
One out for now. I think it's important to watch this space and see what the institutions require and whether going long term it'll be possible for him to remain in that position. I think there are still some issues there, and I wouldn't say this is over by any stretch. I think the really important point to note is that this is a continuation of an issue, as you said, that rose last year. And while there's more accusations and more alarming concerns raised, they're the same themes. And an attempt was made to reach some sort of settlement which involved White remaining in the company, and that on the side these issues would be resolved. That has now fallen over, and we still don't know what the allegations were, nor the legal reports that were filed or obtained by the company about his behaviours. Initially, the company said there was no finding of misconduct by Mr White, but there's been further information since, and my understanding is that Mr White refuses to make those documents public. I think the institutional shareholders will have putting a lot of pressure to bear on that, and even if he doesn't capitulate, if he still insists they're private, I think the documents will be leaked to the market, and I think it will make his position untenable going forward. It may not occur straight away, but I think you would not assume he's won completely yet.
Is there, and I suppose the question is then, how do you see shareholders react, right? Because it seems like a lot of those shareholders were more concerned about having him retained, despite these, you know, allegations and concerns. So I do wonder, when you have the situation when the board is supposed to be overseeing an executive who's also a major shareholder, who's also a founder, who, as you say, is sort of, you know, the magic and the brains perhaps behind the very business. How complex does it get, and is there I guess, a best way out of this conflict?
I think I see three implications coming out of this. The first is, of course, that it shows you that the governance at Wisetech is really immature. I mean, it's been very successful, but it has not really got beyond the founder base and the idea that there's a fiefdom and Richard White is in charge of it. I think that's very much still the case now. And that means also that we need to look at his age and wonder why there's no successor in line for him to take over, and those plans have not been organised. And that's what responsible and mature organisations do, even if you have a founder. And now would be the time for them to be doing that, and they're clearly not going to. The second message I get out of this is that sex and business don't mix, and that as a consequence, really, what it's telling you is that you can't have relationships with staff, intimate personal relationships with staff or with your supply chain. And if you do, you put the company in all manner of problems, like has happened here. And really, we've got to a point now where that has to be dealt with as an issue, and no corporation in Australia is really tolerating that. Wisetech is not on its own here. There are a number of other institutions last year that fell into trouble. Channel 7, Channel 9, Country Road, to name just a few, where there were problems. And so this is an ongoing concern. And I think that the message to Australian corporates is that we do need independent directors, and they do serve a real role here. Some people would argue this is social governance. It's not relevant to the financial running of the corporation. I would contend the two are very connected. And I think the confidence and the trust in the company depends upon feeling that it's subject to robust governance. So if you want to put that at peril, you put your stock market or your stock price at peril. And that's what we're seeing play out here.
Helen, really great to have you with us. Helen Bird, Senior Lecturer of Law at Swinburne University. We do have more on Australia Ahead. That's every Tuesday at 11:40am if you're watching in Sydney, 8:40am if you're joining us from Hong Kong. You can also tune in to the Bloomberg Australia podcast, which delves into the biggest stories shaping the country's role in business globally. Find it on Apple, Spotify or Bloomberg.com. More ahead on the Asia trade. This is Bloomberg.
We have breaking news out of South Korea. We are getting the Bank of Korea's rate decision. They have cut as expected to 2.75%. This is a 25 basis point cut as expected from 3%. This, as all 22 economists surveyed by Bloomberg had forecast that cut, given, of course, the economic challenges that the country now faces. We do have continued political instability. In fact, today, impeached President Yoon Suk-yeol will be delivering his final arguments at the Constitutional Court. You're seeing the Korean won now weaken around 0.1%, still around 1-month highs against the U.S. dollar. We do have the CPI forecast coming from the BOK for 2025 at 1.9%. So they left it at the same level and estimate from back in November. When it comes to growth projections for this year, seen at 1.5%, which is slightly lower than the projection that they had back in January when they were seeing growth of up to 1.7%. For more, let's bring in Bloomberg News Asia economics correspondent Katya Dmitrieva. Katya, if we're seeing right now the projections for inflation and growth coming from the Bank of Korea, the focus seems to be clear right now on economic growth challenges for the economy.
Yeah, it's all about the economy right now. I mean, you just mentioned that growth was downwardly revised to 1.5% this year. That's the second time that that's happened. And a survey of Bloomberg economists actually saw that being revised down as well as our own economists. And the reason is that all economic indicators are really pointing to that. You know, you have consumer confidence that's falling to levels that's kind of close to where they were in the pandemic. You've got weaker business confidence. Everything from retail spending to even trade data for the first 20 days of this month were quite weak. And it's a result of the political instability that you had just spoken about, but also the sort of dimming outlook and the instability abroad in the U.S. specifically, and with Trump imposing tariffs that would directly hit South Korea's economy. So it's sort of the present moment with weak economic growth as well as the long term.
Do we sort of have a good indication in terms of how impactful Trump tariffs might be?
Yeah, so the trade figures, the first 20 days this month, we'll get the final numbers at the end, but essentially showed already that trade has slowed, trade activity has slowed. And the tariffs specifically that Trump has announced, the reciprocal tariffs not so much, but the tariffs on autos, pharmaceuticals, and chips. A lot of these supply chains run through South Korea. South Korea is, of course, also a manufacturer of these goods. And so imposing it on these particular products would only serve to basically hamper growth, again, basically as soon as potentially next quarter. And we heard Trump overnight or this morning in Asia saying that he would be imposing those tariffs on Mexico and Canada at least. So we sort of get a sense that, well, he's serious, that South Korea should really be bracing for these levies, as should the rest of the world.
Thanks, Katya Dmitrieva there as we get that Bank of Korea decision as expected to counter these forces when it comes to the slowing economy. We do have another piece of breaking news to mark when it comes to Elon Musk's Starlink. He's looking to install Starlink terminals in the US airspace network. He's looking to deploy the satellite internet terminals to help upgrade the US Federal Aviation Administration's national airspace system, approving a shipment of 4,000 terminals to the FAA last week. The goal is to get to completion for that overhaul in 1 year. It is unclear how the use of these terminals might impact the existing $2 billion contract that was awarded to Verizon Communications to upgrade critical infrastructure. So Elon Musk's SpaceX is now seeking to deploy Starlink terminals to help accelerate the upgrade of IT networks to support US federal aviation, the national airspace system, according to people familiar with the matter. And of course, the first question, Shery, that comes to mind is really the conflicts of interest for Elon Musk's business empire and this contract that was awarded to Verizon, given that, of course, he has a key role in the current Trump administration.
And Heidi, of course, we're setting up for the Chinese market opens after that huge sell-off that we saw overnight on Chinese ADRs. We're talking about Alibaba seeing its worst sell-off since 2022. Really, Chinese stocks in U.S. trading tumbling on Monday. This, of course, reaction to the latest executive order from President Trump targeting China and perhaps really another look at that bullish narrative that we've had on Chinese markets, especially after DeepSeek's cheaper AI models came into focus. That's it from the Asia Trade. The China Show is next. This is Bloomberg.